Hi, everyone. Welcome to our Finlee Fundamentals. I'm Jennifer Eversole, if anybody doesn't know who I am, and I am going to step in for Erin today and talk to you about a topic that comes up from time to time. It's a little bit different from what we normally talk about, but we thought it was worth presenting to you. And it has to do with how this whole Finlee and client funds reconciliation sort of intersects with our traditional accounting. So in other words, some of you may have previously done your reconciliations in QuickBooks, for example. So when we have people come on, and a lot of times they're asking about what's the relationship between Finlee and your accounting software, which I'll refer to as QuickBooks most of the time, because that's the most popular one, of course. So as we're going down that road, and kind of sometimes it's a paradigm shift for people because you're used to having your client funds reconciliation actually exist within your accounting software. And it's a little bit different when we move over to Finlee, because that's sort of the system of record. So that's what we're going to be talking about today. So feel free to ask any questions along the way, or stop me if there's anything that you want me to expand on a little bit more. So I'll go ahead and jump in. This topic has come up. Again, let me frame this a little bit differently. So I've been a CPA for, 25 years now. And the first 15 of those years, I was in corporate finance with both a payroll service bureau. I was with CBIZ for a while, even with the predecessor company to CBIZ. And then after that, I was with MPay, which is a payroll software company, and doing the corporate finance there. So we've kind of seen it all and kind of done it different ways throughout the realms. But in my capacity at MPay, I worked with a lot of HCM providers on client funds reconciliation and on this topic as well. So that's kind of where we're starting from and where we're jumping in. So let's start with why we reconcile client funds to start with. So when we're reconciling our client funds, our goal is that we're verifying that our client account balances are accurate, which has several meanings. So we want to make sure that our ledgers are accurate, of course, and that's where our subledger reconciliations come into play. If we have aged uncleared transactions, so if we've got transactions posted to our ledger that haven't cleared and they were supposed to, that's a good indication. That's a red flag that, hey, we may have something on the ledger that's causing it to be inaccurate. We want to make sure through our liability variances and through our negative liabilities, also subledger reconciliation items, that everything's posted to the correct ledger, that we've got all of those bank transactions that we're clearing on the correct ledger. So those are designed, and that was kind of the point of Finlee, and when we created it, was to make sure that those client account balances are accurate. So we know that if there's money on this client's ledger, that it's accurate. Then we also want to know, is that balance the correct balance that they're supposed to have? And that's where our liability variances come into play, of course. So that's one of the goals of what we're trying to do with reconciling the client funds. Then we want to make sure that transactions are properly classified. We don't want those dreaded suspense account transactions that a lot of you use a suspense account when you have bank transactions that can't be easily or readily identified. Sometimes we can put those to a suspense account. So we want to make sure we keep those as clean as possible. And then, of course, we want to verify that there's no commingling of client funds with business or personal funds. In this case, we're going to talk about the business funds. And that's not something that we typically talk about. We do use internal ledgers in Finlee, and I'm going to talk about that a little bit more. But it's really important for everyone, and for your business owners and for your stakeholders and everyone, to know that, that's something that's really shouldn't be done. We shouldn't be commingling, and we're going to talk about like what that is, and the few circumstances where it's okay to have temporary covering of things, but generally that's not something that we want to see. The key components of our client funds reconciliation, we want to make sure, again, that we have segregated funds, and you're going to hear me say that a lot here in the next 30 minutes or so. But again, we want to make sure that our funds are separate from operational accounts and are used solely for client money, and that's really critical to what we're doing here. We want to be sure that we have a ledger reconciliation. So each client has a ledger, and the sum of all ledgers should match the bank account balance. And then, of course, the third key component is the liabilities. We need to balance to something. it's really important that when we're balancing to something. And in the case of tax, we're balancing to those liability balances. So depending on what your payroll software is, that's why we're pulling out those pending or those unpaid liabilities, because it's really, really critical that we're not just, if you're not reconciling to something, you're not reconciling, you're just writing down transactions. So that's the third key component of our client funds reconciliation. So let's talk for a minute about how that differs from traditional accounting. So first, let's start with the purpose. So the purpose of our client funds reconciliation is to ensure that client funds are accurately tracked. Traditional accounting, on the other hand, is to track overall financial performance and position. Two very different purposes. One is, again, to, our P&L. We want to know where we are in terms of our net income or balance sheet. We want to know where, it's kind of our statement of financial position there. The focus of client funds reconciliation is, of course, on the individual client ledgers. And while we do look at our ledger reconciliation, we're looking at the sum and the aggregates. That's our high-level reconciliation. Really, the focus is these individual client ledgers. We want to be sure when a client terminates that we are confident when we're giving them back money that we're giving them back the right amount of money. Traditional accounting, our focus is on income, expenses, assets, and liabilities. So compliance. Client funds reconciliation in some industries is very regulated. Law firms that have escrow funds, real estate firms where they're collecting earnest money, things like that. Those are actually very regulated. Our payroll service bureau industry is not regulated, which is shocking to most people when you get down to it. Now, of course, there's money transmitter licensing conversations now across the various states. I think I read the other day that New Mexico just exempted payroll service bureaus from its money transfer licensing. It's a big deal in the industry, and I'm sure you've seen a lot about that in newsletters, but basically that's where the states individually, when something bad happens and you see in the news that a service bureau has lost client money or sometimes even taken off with it in the middle of the night and shut their doors, it happens. And businesses are the ones that lose out on that. So the employers, an employer cannot actually transfer its tax liability to a service bureau. So if the service bureau does something bad and shuts the door and they were holding the client funds, it is still on the employer to pay those taxes. Now, sometimes the states will give them, or the IRS, the federal government will give them some, reprieve from that under the circumstances, but it still is that. So that's where we're seeing a lot of that come into play. We're all kind of still holding our breath to see what happens, because it would really affect this industry. Traditional accounting is subject to regular accounting standards. So we have GAAP, which is generally accepted accounting principles, and then there's IFRS, which is the international version of that. And those are the compliance mechanisms in traditional accounting. The risk of mismanagement. So in traditional accounting, it's financial risk. You do something wrong, you get phished and wire out money, and that's on the traditional accounting side. That's your financial risk. However, when it comes to our client funds, the risk of mismanagement is actually much, much higher. There's legal risk. You're dealing with other people's money. This is not your money. So you have legal obligations, you have fiduciary obligations. So the risks are really legal. They are reputational. You lose client funds and it's very problematic, and the word gets out and businesses go down for that. And then, of course, the financial risk there. You lose the money, it's somebody's holding the bag. Somebody's got to reimburse those funds. When I was probably at the very beginning of my career, I wasn't a CPA yet. I was working at a payroll service bureau basically right out of college. And I learned this really fast because the owner was taking the money and investing it in the stock market in his own name. It was the late 90s, and the bubble burst and he lost the money and ended up in prison. So the risks are real. I've seen it. Various account types on the client funds reconciliation. These are trust or escrow accounts. And then in traditional accounting, of course, you have operational accounts. So I want to talk about those trust or escrow accounts for a minute. So most people don't use actual trust accounts. Actually, I don't know that I've ever seen somebody use an actual trust account. So an actual trust account is where the client retains, the clients individually retain kind of ownership of those funds. They're an actual legal type of account. So when we talk about trust accounts or we talk about escrow accounts, we're not actually most of the time talking about actual escrow or trust accounts, but we do call them that. So when we don't use the formal trust accounts, it's important that we label the accounts clearly. So we want it to say, somehow in there indicate that this is client money, this is not Service Bureau operational funds, this is client tax account or client trust account or whatever that may be. A lot of organizations now, and this is related to the money transmitter licenses, a lot of organizations are looking at what are called FBO accounts, and that's for benefit of accounts. And that's a way to get around the money transmitter licenses, kind of those requirements, because the bank actually retains ownership of those accounts and they're just for the benefit of the Service Bureau. So that's something that's kind of popping up more and more now. And the banks want to ensure that there's some sort of reconciliation of those funds because they're basically handing a blank checkbook to their customers. So those are just different types of accounts and something that we're seeing happening in the industry right now. We need to maintain detailed ledgers for each client, of course, which is what we're doing in Finlee. Reconcile daily. And of course, you all know there's nothing that actually prescribes daily reconciliation in Finlee. In other words, you don't have to do it. If you miss a day, that's okay. We can make that up. You can do it weekly. But obviously, the best practice is to do this daily. It's so much easier when you do it daily. It's easier to find the discrepancies that happened yesterday rather than in the last 30 days. So definitely a best practice there. And then this one is, I don't think, done as often as it should, and that is disclosing the account structure in the contractor service agreement. So this would be something to be like in your service agreements to say, we are holding your funds in an account that's not a formal trust account. Of course, you would word that differently, but basically to tell them that, and that clarifies the fund ownership and the responsibility. So lets them know who owns the funds and who is liable in case of errors. Clients actually like that kind of transparency. It kind of helps to build trust. So it's a really kind of proactive and professional way to do this. It also protects against liability. So if something goes wrong, there could be legal claims or reputational damages that we talked about. And then finally, it ensures that your internal controls are aligned with the contractual expectations. So a lot of you have those SOC reports, your SOC 1. So that's an important part of it, is let's make sure that our internal controls are aligned there so that we don't end up with any SOC exceptions and that everything's just kind of on the up and up. Everybody knows what's going on and what happens there. So let's talk about kind of what kind of prompted this conversation, and that is, what do you do about client funds on the balance sheet? So client funds are not revenue. In no way should client funds hit the P&L other than these circumstances I'm going to talk about in another slide. But basically, when you get client funds, you're not posting it to the P&L. Everything's on the balance sheet. I had same boss from way back when, and I didn't know any better at the time, but I did the month-end close, and we had an account on the P&L called stale check income. And I think you all probably know that that's a really big no-no and probably why he ended up in jail. But rather than escheating the property, rather than escheating uncashed checks, he actually moved that to the P&L and called it stale check income, which is, of course, something that you cannot do. So want to avoid that at all costs. You also want your client funds accounts on your balance sheet to be what are called restricted use accounts. So you want it to be clear that this is not part of the organization's liquidity. So it needs to be restricted use accounts. We have this money, but it is only to be used for this purpose, and that is paying out client liabilities. And then finally, they should be in the other asset liability section. So you're segregating those fiduciary funds from your operational accounts. So that, of course, helps clarify ownership. So if you need to know kind of what journal entry do I post, you want to post your client funds assets, and that should be the sum of your client ledger balances. So then your client funds liabilities, which is in your other liability section, you want your actual client funds liabilities. Then there's two other accounts that you may or may not have, and they're appropriate in some circumstances, and people do this differently, and there are different justifications for the way that they're done. So it really is just a matter of, if you're consistent and you have a proper justification on how you're doing this, really it's not as black and white as some people might think. So you could have a due to from operating account. So there are circumstances, and I talked about no commingling. When I say that, I mean in general. I mean, we don't want to have our operating funds in the same bank account as our client funds. But there are just circumstances where it might be necessary for you to kind of cover something. So let's say you have a big client, it's direct deposit account. Your direct deposit account is generally close to zero because the money's coming in and out at the same time. And you have an NSF, the money's already gone out the door. Well, you have the potential there to have a negative balance, an overdrawn balance, and maybe you need to put money into the account to cover it. Some people guard against that. The way that I always did that was I had a ZBA structure where we had a master account and all of the funds from the individual client account, so the trust account, the trust, tax, and direct deposit, all ZBA'd up into a single account at the end of the day, and that kind of avoided this situation. We didn't need to deal with that because all the money was being aggregated. So because of the tax balances, you wouldn't have that NSF. Obviously, we need to get that money recovered as quickly as possible, but it wouldn't cause this problem. Then you might also have a due from operating. That should be more rare because you don't want borrowing from these accounts. That is strictly prohibited. You cannot do it. The only time that I can see where you might have a due from operating might be if you are, say there's bank fees that came out of the account. And it's a temporary timing thing. Bank fees come out on the last day. You didn't transfer the money back in. You're doing the month-end close and you see, okay, I need to transfer that money in from the operating account. So those kind of temporary things are okay and are fine to deal with. And then finally, client funds variances. So we all have variances. Some Kanban boards are more full than others, but there's always going to be variances. Just it's the nature of what we do. So if you're posting the sum of your client ledger balances and then your actual client funds liabilities, the difference between those two could be put into an account called client funds variances. I don't see that done very often, and I'm okay with not doing that as long as you're actively resolving variances. They're not out there for a long period of time. It's a temporary thing. There's also materiality considerations there. So if you've got $100 tax variance, you might not want to put that there. It might not be necessary because that might be considered kind of immaterial and a temporary timing difference. So most of the time what I see are the first 3 accounts without the client funds variances. If you don't have that client funds variances, then you're just going to post basically what's on your ledger reconciliation as of the last bank reconciliation of the month. So let's say on 7/1, I do my bank reconciliation for 6/30. I do my ledger reconciliation by clicking the Find Variances button. And literally those are you've got a ledger balance there and you've got an adjusted bank balance. It is important that you use the adjusted bank balance most of the time. There are arguments to be made if you operate as cash basis that you wouldn't do that, but it really doesn't make sense. You would definitely have lots of variances if you did it cash basis, but you want to include the adjusted bank balance, which includes those, we'll call them deposits in transit or payments in transit. So typically we're going to see the assets, the liabilities, and maybe this third one, and rarely do I see somebody post the variances actually on their balance sheet. So to show you that, I actually went out to CBIZ's website on their investor relations and got CBIZ's, this is their balance sheet that they published for last quarter. And you can see that here are the funds held for clients. So they have a current assets before funds held for clients. So separates that out. Remember, I said that we want to make sure that is clearly segregated into what are client funds and what are not. So they have 118 million here on the asset side. On the liability side, it was interesting to see that their liability side is slightly lower. And the reason for that, I went to the footnotes to see if they made any comments about what they were doing there. And they said that some of their funds are invested in marketable securities, and those result in unrealized gains or losses. So when they post the amount here, this includes an unrealized gain or loss. And so it's not always going to match these liabilities. So it's unrealized because the money is still in that marketable security, and they haven't actually earned the additional money. They haven't realized the additional earnings. So that's why those are different. So the offset between those two is going to fall down here to the equity section, because that's going to be on their P&L as unrealized earnings. Or unrealized losses in some cases, but in this case, it appears to be an unrealized earning. So that's how they separate it out. I looked at ADP's, and theirs was very similar to this, but again, they don't show their variances on here, and neither does ADP. And I can assure you, with that many customers, they have some variances that they're tracking and resolving. They cited materiality as their kind of threshold for putting that on the balance sheet. All right, let's talk about when we post the journal entry. So do you need to post this every day in QuickBooks every time you do your ledger reconciliation? And really the answer to that is because when you reconcile in Finlee daily, you have operational control and visibility. You have control over those client funds. You know what you have. You've got your ducks in a row, and you know exactly what's going on with that client money. The second thing is you're meeting your fiduciary responsibilities. So I know everybody has a bank account probably, and do you expect your bank to wait until the end of the month to make sure that the money in your account is correct? Of course not. You expect the bank to have a daily, nightly, hourly process where they're ensuring that what's on your statement is the correct thing on your statement. What's in your account is what actually should be in your account. And really, your clients deserve that as well. It's no different. They're entrusting you with money, so that you have a big fiduciary responsibility to make sure that all of the money is correct and you're tracking everything. And then finally, Finlee lets you respond to client inquiries and audits with confidence. So again, back to that terminated customer, that's the example I always use. They're leaving. You may never talk to them again. You may not be able to get in touch with them. You want to make sure that when you are giving them back money, that you're giving them back the right amount of money. So because you're able to do all of these things, just post your entry at month end. As long as Finlee remains your system of record for your daily activity. And what I mean by that is, like, I use the payroll example. So if you're using ReadyPay or UKG and your customers are using that as their payroll, when they're posting their journal entries probably into their accounting software, they're posting one journal entry. So they're saying, credit cash and debit wage expense for their payroll as a whole, for the aggregate. That's how most people do it. Some people put the individual paychecks in, but most of the time people just have that information in there as an aggregate, because the payroll system is the system of record for payroll. So if they need to know information about an individual check or an individual payroll item, they're not going to QuickBooks. They're going to ReadyPay or UKG or iSoft. Same is true for client funds. Like, we can look on that balance sheet, and I have to overcome this sometimes when people come on board with Finlee, because they, it's just kind of a paradigm shift where we've had all of this information in QuickBooks for so long that it's hard to kind of make that shift and know that we just need that journal entry at month end. It's literally one line debit, one line credit, maybe the due to from operating as well, but it's basically just one journal entry that does an adjustment from the difference between last month end client funds and this month end client funds. And then let Finlee be your system of record for the client funds activity. It doesn't need to be in both systems. And then as long as you summarize and post your journal entries that reflect the client funds received and the liabilities, so that's what we just talked about, and as long as you retain supporting documentation to back up your entries. So that's your ledger reconciliation. You can always go back into Finlee and pull that later. It's there. You just need to make sure that everything's documented. So let's talk for just a minute about the P&L impact related to client funds. So I think when we started, I said your client funds never hit your P&L. So here are some examples of when it might have to hit your P&L, and not always a good thing. So an unrecoverable NSF. So we've all had that NSF where that customer disappears on you and is nowhere to be found. Again, that's a risk that we take as service bureaus. It's a known risk. It's something that we really can't avoid unless you are, transferring that risk to a third party like a net pay or a coda pay. But if we have an unrecoverable NSF, that is going to go to your P&L. You just have to cover it. So there's nothing that can be done about that. It's no different than a client who doesn't pay their invoice. It's just the dollars are sometimes much larger. That's why those internal controls that we have are so important, because every payroll that you process, you're on the hook for, ultimately. The second thing is bank fees. So again, bank fees, if they come out of the client funds accounts, you're going to transfer those over from your operating account, and then that's going to be an expense on your P&L. Penalties. So penalties meaning IRS penalties, or bank penalties for NSF or something like that. But anything that you choose to pay, it's your option. If it's a client penalty, if you're going to impound the client for it, if you're paying it, if it was a service bureau error, is the way that normally works. Those, of course, go to your P&L as well. Interest earned, when we're getting interest on those bank accounts, whether it's investments or whether it's just sitting in a checking account, or sometimes we have longer term investments, and I'm going to talk about that in a minute. Operational errors. So again, if you send a tax payment file twice, you can usually get it back from the IRS, but there are certain operational errors where we might not be able to recover that, and the Service Bureau might just have to kind of eat that. Fraud or unauthorized transactions. Again, I can't emphasize internal controls enough. It happens all the time. So make sure that you have good internal controls and don't find yourself in a situation where there's fraud, whether it's internal or external, and that you're always kind of on top of that. And then reconciliation adjustments. So those are the, we just found out that there was a terminated customer from 3 years ago, and we didn't impound them for a payroll, and the customer's out of business. You can't recover that. Again, same as the unrecoverable NSF, you have to fund that money back. If you don't fund that money back, that means that you're using somebody else's money to pay somebody else's taxes. So it's very frowned upon. It's illegal. It's not something that you can do. So you have to stay on top of those. All right. Pitfalls that can lead to commingling of funds. So the first one is kind of the most common, I would say, and that is mixed invoicing. So don't collect fees and client funds on the same invoice, because it's going into the same account, whether it's going into the client funds accounts and you're moving the money out, or it's going into an operating account and you're moving the money in. It's just not a good situation. It's not a good idea. There are other solutions. So I always warn against mixed invoicing. We talked about the bank fees deducted from the client funds account. We talked about the interest. Don't use client funds to pay business expenses. That sounds obvious, but sometimes I have to say that out loud, like that's not okay to do. Depositing client funds in your operating account, just don't do that. Even if it's just temporary, try to avoid it. So a lot of times in terms of the bank fees or the interest earnings, a lot of times the banks will allow you to designate a different account for those. That's the best case scenario. Just have it go directly to or from your operating account. If that's not possible, be sure that that's getting moved every single day. Lack of segregated accounting. So have your Finlee as your client funds and QuickBooks as your accounting of record, systems of record, and that helps with that. Unclear fund transfers. So this is just about documentation. So you're moving money around and you don't have your notes in there to say exactly what it is. So it gets lost, something happens, you transfer money from your operating into your client funds accounts and you don't put a note on it. So then a year later you forgot, and I think I put that money in there and now I need to move it out, and it just becomes a mess. Covering those NSF shortfalls without tracking. So you sometimes have to cover them, but if you don't have good documentation and notes, those things can get lost. And then client funds adjustments paid from the operating account. Of course, failure to reconcile regularly, and investment losses can also lead to commingling of funds. So that's an interesting example. So say on that CBIZ example, they had losses instead of gains. Something terrible happened. They put it in a bad marketable security and something bad happens and there's actually losses. That leads to, if you don't recover those, if you don't move money in from your operating account, then that will definitely lead to commingling, because you need to replenish for those investment losses there. All right, finally, I'm going to talk for just a minute about investing client funds. That is perfectly fine to do. Some people question that and wonder, should we be able to invest our client funds? And it's perfectly acceptable to invest the client funds as long as you know that there's risk there. If you lose money, if you invest in something that can lose principal, then you've got to replenish that money. So it's best to create a formal investment policy, and this gets very, very formal. It needs to not have a lot of room for error. So, for example, you might have an investment policy that says, I'm going to take the excess over the minimum balance in the tax account over the past year and take 75% of that. And then you want to divide that out into different investment types. So maybe you have long-term investments, mid-tier investments, and short-term investments, and that all has to do with liquidity. So we need, for tier one, which would be, okay, I need to be able to get to this money right away. So it might just be those overnight sweeps where we're getting to the money right away. They're putting the money back in, but maybe you've aggregated all of your client funds and it's earned more money. We went through a period of years where interest was so low, people just stopped doing this. So a lot of banks will allow you to offset your bank fees with your balances that you're not investing. And over the past long number of years, interest has been so low that was what most people did, just offset their bank fees with their balances. But now a lot of people are investing because rates have started to rise, of course, and over the past year or so, I think people are really starting to make more money, and it's a perfectly valid revenue stream to have. So if you're not investing in your client funds, that might be something to consider. Of course, you have to know what you're doing and have that investment policy. You have to have risk management treatment. You have to have oversight of it. Basically, you just have to do it well if you're going to do it. So this is, of course, where you reconcile investment balances regularly. You can do that within Finlee. If you have an investment account and you have client money in it, that account should be set up in Finlee. And anytime that balance changes, then you need to be doing a bank reconciliation for it. And so that allows you to track that and to move forward with that. And then you want to disclose your investment practices and client agreements. So again, you have an investment policy, as long as it's sound and secure, you want to just disclose that to your clients to avoid any potential disagreements. And again, you need to make sure that your liquidity is addressed. And then finally, the very last thing I'm going to talk about is unknown variances. And this is a very touchy topic for a lot of people. And it's something that people don't think about maybe as often as they should. But it is a fact, and it's kind of a fact of what we all know. So we all know that people in our industry and, in our independent payroll provider organization, this client funds reconciliation has been an issue for literally as long as payroll service bureaus have been around. And there weren't tools before. Like, we use spreadsheets and we use sequels. And we've gone through a million iterations, and that's really why Finlee was created, because there was nothing out there that did this well. So a lot of people, almost all, have unknown variances. So when you start with Finlee, you've got that delta there that gets posted somewhere, and it's your unknown variance. Well, you have to make a decision at some point on what you're going to do with that. So overages, it's not most common for a service bureau to come to us and have an overage as their variance, but it does happen. And you have to make a decision on that, or it's the right thing to do to make a decision on that. So every state is different, and the rules on it are dictated by the state. But pretty much every state says if you have overages that are unknown, so you've got extra money in your client funds accounts and you don't know who it belongs to, number one, you have to do due diligence. So you have to try to figure it out. You can't just throw your hands up. You have to try to figure out who that belongs to. And then every state has a waiting period. So they're all completely different. 1 year, it could be 1 year, it could be 10 years, but it just depends on the state. After that waiting period, if you haven't figured out what that money is for. Like the waiting period is there so that, let's say you get a tax notice for a 100K tax payment that you missed 2 years ago. You know that that's part of your overages if that was unidentified before. So that allows you Tom, to try to identify it, to wait and see if somebody comes knocking on the door looking for it. And then at that point, you're supposed to escheat that money. I think that's true in every state. You have to check your own individual state, but you're supposed to turn that money over to the state. That's the part that people don't want to hear, because that's scary, because what if you turn it over to the state and then you get the tax notice? So it's not a fun thing to hear, but you are supposed to turn that money over to the state. It's the right thing to do. Shortages, on the other hand, of course, investigation. You want to try to figure it out, try to find who you're supposed to collect from, see if you can collect it. Temporary coverage means using your operating money to cover that if you need to. And then finally, write it off. And again, not something that people like to hear, but it's going to go against your P&L. In real practice, I've seen it done a number of ways. Somebody comes and starts with Finlee, and maybe you're short $100,000. I think it's a valid strategy to say, okay, over the next 5 years, I'm going to replenish $20,000 a year until that's recovered. Just have a strategy and know what you're going to do with that, because it's not a problem typically until you stop processing. And the minute you stop processing, you know that's going to fall out short, and there needs to be a plan on what to do with that. So it's a painful topic, and one that we dread every time, but it's a problem. And the good news is, you're clean from when you start using Finlee forward if you're using it the proper way. So that's the good news to end with, and that's why most people come to us. So I'm happy to hear that, but again, we need to figure out what to do with what happened in the past. So I think that was all I had for you. If anybody has any questions or wants to talk about anything anymore, or have a more private conversation about it, I'm happy to talk to you or your owners, your stakeholders, or anybody else about this topic or anything else. So there's my contact information if you want to shoot me an email.